Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blickery, your host, and with me is the voice of the people, Sydney Freed. And now, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming back Michaela Galina, Wave HQ Chief Financial Officer. She's been buy-side, she's been sell-side, she's been C-suite, and she is here today. And today we are going to be talking about the great value investing renaissance. You heard it here first, with a focus on our phrase of the day, which is investor psychology. What are the three cognitive biases that threaten every investor's trading account? Also, this episode is brought to you by the number 4.4%. That's how much value stocks have outperformed growth stocks since 1927, almost a century. Are we ready for a game of catch-up? So, Michaela, we've had a lot going on this year. Just tell me what you think of the markets right now.
You know, I'm really bullish on value stocks right now, and I think the macro is telling us to be that way a little bit, right? You're seeing inflation that's greater than the last decade. You're seeing interest rates continue to remain elevated, and we're in a period where growth stocks have done really well, and all three of those things typically portend to value stocks doing well. So I'm bullish on value. I think the market trading at the multiple that it is today of 2 times what it typically trades at feels a little rich, and I think value stocks are becoming to come in vogue. And actually, we've seen that in the first month or so of the year, where the Russell 3000 value has increased, call it 4.5% versus the same growth indice, increasing maybe 25 basis points. So might be seeing a shift of sentiment there.
We're calling it the Great Value Renaissance. We'll get into that in a few minutes. We want to tackle our phrase of the day right now, which is investor psychology. So investor psychology refers to the emotions, the biases, and the decision-making patterns that influence how people invest. So it includes factors like fear and greed, overconfidence, loss aversion. And these things impact buying, selling, and also risk-taking behavior, where you put your stop, if you have a stop. Take us through some of these things that we have to be concerned about. Anybody pulling the trigger is facing these.
Absolutely. And, I have seen these biases come from basic retail investors, and the data shows us that, all the way to working for a self-made billionaire at one of the largest growth shops. We all face these same issues. The three that I really pay attention to are loss aversion, recency bias, and confirmation bias. I think loss aversion is fascinating because it's essentially the concept that we feel losses as an investor at 2x the rate of the emotion that we feel joy when it comes to gains. And there's fascinating neuroscience about this. The neuroscience actually tells you that when you feel a loss as an investor, the same part of your brain that lights up when you feel physical pain lights up. So that just goes to show you we're already against human nature in such great form to not make trading decisions based on emotions, or at least to try not to.
I've seen this in play on X, where people tend to brag about having 99% winners as though that's possible, as though that's a desired goal. The pros, I can tell you, have maybe 1 in 3, 1 in 2, sometimes 2 in 3, depending on your investment style. Those are the win rates, and losses are part of the game. So how do we tackle this as investors? How do we get beyond these things that are holding us back?
I think just being aware of these cognitive behaviors is the first step. Understanding that you can make emotional decisions and it can hurt you versus staying the course over the long term, I think is always the first step. The second I would say is if you use typical value frameworks of looking for true intrinsic value, of using free cash flow as a good metric, of understanding valuations over time, and you stick with the fundamentals, to me, value investing is all about continuing to stick with the fundamentals. If you look over a 30-year period, if you tried to time the market and you missed the 10 best trading days over a 30-year period, your portfolio gains would be 50% less than someone who stayed invested.
Those are always at the market bottoms, though. Those are always in the bear markets. Like, you got to be in the bear markets to get those big days.
Let me ask, is loss aversion then the one that you think is most damaging of those three?
I think to a lot of investors, yes, because it tends to have much more of a lasting effect than a recency or a confirmation bias. In fact, JP Morgan did a survey in 2024 that showed retail and 40% of retail investors tend to sell at market lows. So they're feeling those losses even more painful. Yes, and then the emotional toll on top of that is even greater. So these emotional swings can cause really terrible decision making.
What about for just a passive investor? Because if you're only in ETFs, mutual funds, are you really feeling these biases the same way as someone who's actively trading stocks?
Well, I think being an active trader brings on a little bit more risk. If you're being passive and you're following what's happening in the markets, that's by definition, you're kind of sitting on the sidelines. However,
you could still have FOMO.
That's right. And that's part of it is you might have recency bias or confirmation bias because you're hearing in the news, you should be diversified in ETFs. So maybe that's why you kind of look to more passive strategies. We tend to be more influenced by short-term news and headlines than we are long-term trends. And so as the market evolves, I could see traders who might think a passive strategy right now is the right thing over time may think differently or the same.
Just engaging in that passive strategy could be a decision that's affected by recency bias and these other cognitive distortions. Talk to me about, there was another bias, confirmation bias. So talk to me about that. All right, everybody else is doing it, maybe, so I'm doing that. Is that in that vein?
A little bit, because I think we naturally as humans are all seeking confirmation that what we believe our views to be are true. And so if you have a thesis on a stock, you will naturally, and again, this is what we talked about earlier, you have to be aware of these things because you're naturally going to want to pay attention to data that supports your thesis. You're going to weight that more. In all actuality, studies have showed you weight confirmation.
That's what social media is for.
Oh no, please no. But you weight the confirmation greater than you weight facts that are an aversion or different from your thesis. So again, it's really being aware of what these things are so you can have an intellectual conversation with yourself and say, okay, I'm seeing this analyst downgrade this stock. Does that mean I think it's going to be cheaper and it's a value play, or are you just getting stuck in the rut of confirmation bias?
All of these things are high risk, high reward though, right? Because confirmation bias can bring you that high reward if you're willing to get in there and you don't need to get confirmation.
I think so, but I really like to follow the tenets of Benjamin Graham, of his investment philosophies. And he's really all about patience and staying the course and studying intrinsic value. And I think value stocks tend to, not always, but tend to have less downside naturally, right? Because their multiples are cheaper than what they've traded historically, right? So I view a little bit of downside protection in a value stock. Then again, when you think about Benjamin Graham's principles, he prevented you from making a really big trade on a opportunity of a lifetime, and you might miss out on those gains, but you're being buffered on both sides to kind of, I would say, protect yourself from your own human nature and will.
You know what's interesting? I noticed this works well in technicals too. I come from the technical school, and all of these principles that we're talking about apply just as forcibly with the technicals as opposed to fundamentals, but we just deal in things with different ways. So the information coming to us, it's not information from the company, it's not their financial statements, it's from the charts. But we have to read those charts in a consistent way, and we have to maintain an unbiased mind, which is very difficult. And so in the end, we're all reading numbers and trying to find out and trying to figure out opinions, but there's so much that could go wrong.
It's a really good point on the technical and quant trading, because that's such a big trend right now that we're seeing, but you still need the human element to interpret and make decisions.
What are some areas within value stocks that you like right now, some sectors?
Well, the energy sector and banks have kind of historically had a lower valuations. We're starting to see some improvements there. I'm following the energy sector. It has improved, but one interesting data point that a lot of us see is what Warren Buffett does, right? And he has now a 30% stake in Occidental Petroleum. What is so fascinating to me about him building a position in that stock is because over the 9 prior quarters, he's been a net seller of stocks. So he's being very conservative.
He does.
He does. He trades in and out. But he's built a longer term position when he's otherwise in this stock, in Occidental, when he's otherwise been on the sidelines from the market generally.
Now, he established that position, correct me if I'm wrong, 2018, 2019, it was before the pandemic.
Yep.
And he also got a really sweet deal. He loaned the company money, basically. He got preferred stock, so he was getting something like a huge above the market interest rate, basically, on his investment. So when people look at Warren Buffett and they say, I want to be an Occidental because Warren Buffett is, they're not getting his trade. You might get in on the common stock, but you're not necessarily getting that sweetheart deal, and so it's not the same trade. Would you advise for people to just kind of trade like Warren? Or
I think data is information and it's power, much like the biases that we just talked about, right? So to follow what he's doing, I think, is a signal. You can't maybe invest in all the same ways, but you can look at it and say, why is he investing in this company? The multiple is cheap. It has strong and consistent cash flows. Over time, you believe that the sector should re-rate based on the cyclicality or whatever it might be. So again, I think it's good to just understand the data points, be aware, knowledge is power, and then, use your own intellectual honesty to determine what your risk appetite is, what type of investments you should or shouldn't be making, whether you should even be in individual stocks or things like more passive investing that you talked about earlier, Sydney.
Following people, and I don't want to say people like Warren Buffett, but following anyone's advice, like an analyst or a big trader, is kind of its own form of confirmation bias, though, right? Like, you're just saying, like, well, that person that got one call right said to do this, so I'm going to do that too. What do you think about that?
They always say do your own homework.
Yeah.
So it's all your responsibility.
That's right. Well, I think that's one of the reasons that you see top trading firms actually employ a psychologist. And as you're making trades, the psychologist will ask you, how are you feeling about this? What's your body's reaction? Why are you thinking these things? Are you paying attention to this other side of your argument? And why do you have a different opinion? So they're really getting at all the things that we've just talked about in terms of making a sound decision, because we all fall prey to it no matter what type of trader we are.
So on that note, we're going to take a very short break. Coming up, we're going to be talking about the value renaissance. That's the third time I've mentioned that here, along with a very equestrian who wore it better. This episode is brought to you by the number 4.4%. Now, if you go back a century, almost to 1927, that's how much value stocks have outperformed growth stocks each year. Though 4.4% doesn't sound like much, but it compounds, and that's where the magic is. So we haven't seen a lot of value this century, and we've kind of alluded to that, and we've talked around it. But why is now the time that value is coming back that you see?
I think it's from a number of macro factors. Higher interest rates than we've seen over the last decade, and higher inflation. And those two things typically help value stocks. And by the way, they also typically hurt the growth stocks, right? Because growth stocks need to rely on future growth. They need to fund the future growth. And all of a sudden, their cost of debt is higher and their input costs are higher.
They need cheap money, yeah.
That's exactly right. And so we're coming out of that period. And I think interest rates will continue to remain in the age that they are right now until we can get a better grasp on inflation. So it remains to be seen. But one of the other things we haven't talked about is that so many of the tech stocks and some of the Mag 7 names have outperformed so greatly that they have unintentionally become significantly overweight in portfolios. And we're seeing managers and investors who want to better diversify, so they're seeking the value opportunities with some of the gains that they've had in growth because they're overweighted.
Yeah, because I was going to say, if you're a young investor or, again, a passive investor in mutual funds and ETFs, I would think like go growth, because growth is intended to grow long term, right? Like my instinct isn't to say value as a 30-year-old investor. I feel like, am I wrong? Like,
well,
it's being old here with the value talk here.
I just want to grow.
I would say I'm typically a fundamental investor, and so I look at patience and I look at things and over the long term. And as we just talked about, Jared just mentioned, over the long term, it's proven over and over and over again that the value stocks outperform growth stocks. Doesn't mean it will every single year or every single cycle, but if you're willing to be a long-term investor, absolutely. And then you can still be a growth investor, and you don't have to be mutually exclusive to value stocks, right? You can actually still be overweight in growth right now. Right, and have a portion in value stocks.
So how are these firms going to redistribute like the weight of their funds? Because you were just talking about that.
Yeah, I think it all depends on each goal of the fund and what their performance benchmarks are. So it really varies what your personal investment goals are. For example, I'm a big fan of diversification. Diversification means different things to different people. Diversification for an older person who's retired might mean that you're heavily weighted into value stocks, right? And bonds and things that are known to be safer. At our age, we can tend to take on a little bit more risk. We can be in more growth stocks. But again, that's not mutually exclusive. You can still be playing this tech stock AI craze without a doubt and still look at undervalued value stocks that are compounders, large cash flow companies that are not going away, that are going to be a foundation of your portfolio too.
Are you more a stock picker, like individual names, or do you go by sectors, themes, styles, that kind of thing?
I tell my friends all the time who are not in this business, if you're a retail investor, you should never be investing in individual stocks. I feel very strongly about that. Having worked on Wall Street, having been an investor, I believe...
You've seen how the sausage is made.
Yes, I've seen how the sausage is made. By the way, I've seen it behind closed doors on the corporate side. And if you're an analyst at a top fund and you're a top shareholder in a big name, you have access to that CEO very often. You have access to the management team. You just have more recent flow of information. So watch out for the recency bias we talked earlier. But you have access to more information, I truly believe that, than a typical retail trader who is at home surfing the web at whatever speed they have and reading publicly available documents. It's just a different game. And I think having individual stocks is significantly more risky in today's market. It's much harder to be a stock picker today than it used to be, I believe.
Going back to the fact that so many of these ETFs and mutual funds are kind of overweight growth stocks, if you're a passive investor, then how do you diversify? Like, I always look at, my options just going into ETFs, and I'm like, well, again, they all have Meta, they all have Nvidia. Like, how am I supposed to know which ones to choose and diversify when I feel like I'm just picking all the same stuff?
That's a great question. I think you even have to take one step back further and say, what is my asset allocation going to be, right? So you're taking it not only from an individual level in a fund and what the weightings might be, or what indice you're trying to track.
Bonds,
exactly. Stocks, bonds, commodities. For a long time in money markets over the past few years, you could make 6 or 7% in a money market account with no risk. So it really just depends on what you're looking for as an individual investor, how much risk appetite you have, and again, what your overall portfolio should look like for every individual person.
Just kind of thinking about our theme here with investor psychology, I believe that the great value trade, as we're talking about it, might have become overextended when you finally see it on the cover of Business Week or something like that, because that's another aspect of market psychology, that by the time you get a new ETF class, by the time you get something that makes a magazine cover, which takes weeks or months to plan in advance, well, that trend tends to be over. And we see this in so many different ways. I'm wondering if that's part of your psychology insight as well.
Another data point to absolutely take note of, because a lot of times when something gets that mainstream, the market is already caught up from a rationality perspective and everything is fairly valued because it's well known. So when I'm thinking about value stocks, I'm thinking a little bit more about what hasn't been discovered. Almost a contrarian mindset, right? Back to our examples with Benjamin Graham. By definition, value investing is a bit of a contrarian appetite, because you're looking at a stock that is valued at significantly less than it either used to be or its peers, and you're saying, I believe it should be valued more, but the market's telling you it shouldn't be. So there is this whole cycle of understanding, am I really buying value? Am I a contrarian? Mm-hmm. What does the market say versus what I think?
We talked about the pain of losing and risk a little bit. Do you know anything about the psychology of winning?
Kelly knows everything about the psychology of winning.
Do you know what it's like to win? No, but I'm curious, does scoring, okay, you invest in the next Nvidia and all of a sudden you're drowning in all your money and you're like, wow, I can do anything. That seems really dangerous too, if you just happen to be lucky or you're a one-hit wonder maybe.
Right.
Life isn't like the cartoons where you can swim through your gold holdings.
That's right. Well, I think this plays out in two forms, because one, yes, if you hit it big, all of a sudden it feels like gambling and it's a bit of an addiction, and you probably have too much confirmation bias a little bit on your own decision making. On the other side, aversion loss actually flips to the same thing on gains in the opposite nature. So aversion loss also presents itself as, oh, I've made a certain amount on the stock, I've made some gains, I better take my gains, and you actually give up further gains. And so you have to pay attention to that too. And while we tend to have the physical feelings and fear much more on the losing side, we tend to give up the green on the upside because of that same type of concept.
I've also noticed that there is something addiction to random results. So people will just pull the trigger and get surprised and hope they get surprised in a good way. That's the thing too.
Are you sure that's not just because they don't know what they're doing and they're like, well, I might as well try it?
It's a way to capitalize on not knowing what you're doing. I swear it's a thing. It's been studied. But we have to get to today's Who Work Better, and we are going to tap into our guest's equestrian background. So investing is a long game, requiring patience, discipline, and the right temperament. It's just like a competitive equestrian sport. And if we're leaving this somewhat open-minded today, we're going to ask you, Michaela, if investors were horses, which breed? You're laughing, Sid. Which breed would best capture the spirit of a successful long-term investor? A few examples. The thoroughbred, lightning fast but burns out quickly. High growth, anyone? The warm blood, balanced and steady. A classic long-term winner, but steady alone doesn't always win in the end. The Arabian, smart, independent, sometimes volatile. A contrarian's dream, maybe. The quarter horse, adaptable, reliable, unshaken under pressure. Sounds diversified, maybe. And finally, the Clydesdale, not just for beer commercials. It's slow, steady, and unstoppable. But does it get mired itself in value traps? So Michaela, which horse wears the long-term investor's best self here?
Gosh, owning and showing warm bloods, I can tell you that is your growth. That is your growth horse,
Yeah.
without a doubt. I think of more a standard bred, a pacer, or a trotter when I think about the value investor, because they can maintain the same pace for miles and miles and miles at a time. They don't break gait. They don't change the pace that they're changing their legs. They stay true to the course, and they're just on a path and continue to follow it. And if value investors could only follow the same fundamental analysis and stay the course through time, I think they'd be on the same track and they'd be winners too.
This is extremely niche. I know nothing and I love it. What is a quarter horse?
A quarter horse is the traditional American breed for cow sorting, trail riding. They're very friendly to both new and experienced riders. So we see a ton of quarter horses in America.
But the quarter comes from a quarter mile. They were bred to race a quarter mile.
Correct, they were for short sprint distances because they're shorter.
This is everything I know about horses, by the way. I don't know. Have we cycled through your content?
No, I'm still processing, but please.
So let me just ask you about your time in the buy side. You were kind of hinting that the average retail investor doesn't have access to the same things that the professional does. But if you're an active trader, if you are sitting at home and this is your job, you're going to trade. So what information should you be accessing to put you on that level footing?
I think you need to do very detailed fundamental financial analysis. And I also think you need to be paying attention to the big names that are covering the stocks because they're going to have a little bit closer access than you have. So
actually listen to the analysts that we have in our shows here.
Yes, absolutely. And it's one voice that you need to be paying attention to make sure you understand the other perspectives on that stock in the marketplace. And also so you can go do your own research on the similar topics. But yes, absolutely. You need to know the voice and the sentiment of stocks that you're paying attention to in the marketplace.
I'm curious about something. Can a growth stock turn into a value stock?
Ooh. We've seen this.
Yes.
Peloton, anyone?
Yes. It's usually a pretty painful journey. And I think most companies have to be very, very intentional with their shareholders about making the shift and about trying to time that correctly for when that's going to happen so that the investors are not surprised. Because if you're going to have a turnover from growth to value investors, you're going to naturally have people moving out of the stock. But you got to make sure you've got a real credible value story that you really haven't proven yet to get the value investor bought in.
But the way you're making that sound is almost like value stocks it's a bad thing. But it's not a bad thing.
Not at all. Not at all. In fact, companies should only try to be exactly what they are. That's, I think, the most important thing.
I think that's good advice. We got less than a minute here. Any final words for investors, psychology, risk management?
Oh, risk management. I would say just investors, whether you're at a retail level or an institutional level, all need to be paying attention to risk management. Your risk appetite is very different than someone else's. It's very different than another fund's. And so you need to be very cognizant of it when you're making investment decisions.
All right. On that note, we're going to wind things down here at Stocks in Translation. Be sure to check out our other episodes of the show on Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. So be sure to leave a comment, and subscribe wherever you get your podcasts. And we will see you next time on Stocks in Translation.